Hello and welcome to Livewire's Undiscovered series. I'm Ali Selby and today we're incredibly lucky to be joined by the Chief Investment Officer of a family office, MRB House, that's Peter Magee, as well as the CEO and founder of capital raising business Walsh Capital, Louise Walsh, for their insights into how Australia's ultra wealthy invest and discover under the radar funds. Thanks so much for joining us today, guys. We don't often get to speak to guests of your expertise, so I feel really grateful and I hope our audience does too.
Yeah, nice to be here. Thanks for having us.
Peter, I'm going to start with you. Do Australia's ultra wealthy, the high net worth investors, do they invest like the rest of us? Do they invest in stocks directly or ETFs?
I think you'd find they do. Is just variety in their strategies. So some will invest exclusively in passive. That's probably a minority. Some will invest exclusively in active funds. That would cover a large portion. Majority overall will be across both. It'd be a hybrid, mostly active, and then a selection of passive as well. And we find the biggest question you have to ask yourself is, to what extent should I be in passive? The way we think about it is that if you have a portfolio that's going to deliver, say, 9% in line with the market, you're making distributions of, say, 5%, it gives you 4% net, which grows your capital base. Now, if you add 1% alpha, that's 25% increment on how you can grow your capital base. And if you had 2% alpha, it's a 50% difference. So the rewards are very vast. And we think you find in inefficient markets, they're very good cases for active managers to outperform. So we're attracted to that style of investing.
That said, not all active managers manage to outperform their benchmarks over the long term. Louise, I'm going to turn to you now. Where is the smart money looking to allocate? You speak to high net worth investors and ultra wealthy investors every single day. Where are they looking to allocate and where are they usually avoiding?
Thanks, Ali. Well, look, I think with ultra high net worths, whether it's family offices or others, individuals, families, there's definitely, from my perspective, I see a lot of interest in alternative investments. So when I first started the business, I did do a little bit in the equity space, and what I found is that most people or families would say, look, we're quite set with our equities portfolio, so it's probably going to take quite a bit for us to adjust that and add a new manager, because it may mean we've got to take one away. So there's definitely, an increasing interest in the alternative space. In more recent times, definitely private credit. I would say there's a lot of private credits around, credit funds around. I actually haven't raised for a private credit fund, mainly because there's been so many of them. The other thing I've found is that, especially with the younger generation coming through, there is an increasing interest in climate impact type funds as well. So people need obviously to be very cautious in that space. There's the greenwashing and whatever else, but there is an increasing interest in that space, particularly from families that are involved in philanthropy or have an interest in the philanthropic space as well. As far as avoiding, I suppose, I do see some families and people in more recent times that can be a little bit overweight in things like private equity, venture capital, so they're less inclined to invest in that space, and probably more so venture capital at the moment. So that is something that I think I see people being particularly cautious about.
Is it the same for you, Peter? Which areas of the market are you typically avoiding?
I'll talk to one particular case, which is developing markets. So we are not investing in developing markets. Some people believe there's a valuation argument for it, but we think there's better alternative opportunities. And for us, that would be domestic equities. So if you look at the Australian market in the long term, it's had phenomenal performance. It's 10.8% when you look over periods of more than 100 years. There's no FX exposure when you invest in Australia. There's local insights. So I met a fund manager today, for example, and we sit across the table and you just get more understanding from speaking to a manager directly. And the tax system's quite favourable in Australia as well. Now that's only 2% of equities globally. So then we look internationally and we prefer the US market. We think the biggest mistake investors have made of not being sufficiently exposed to the US market in the last 10 years. So the S&P's 500's done 12.5% per annum, which is a prodigious return in that period of time. And it's just got significant competitive advantages versus other countries. It's the centre of excellence for technology, and they also operate at significant scale. So US businesses, when they look to export, they're already operating with very effective cost structures. So we're positively disposed to the US, and we think that's a better proposition than, say, developing markets.
I think that's really interesting because we speak to so many experts who absolutely adore equities and debt in emerging markets. Would you recommend investors just don't explore that area at all?
Well, it's quite a subjective case, right? And I think the biggest element at all is valuation. And some will say that the US cycles run too long, valuation levels are elevated. We feel the more significant considerations are sovereign risk, and we would favour the most dynamic economies. And long-term history, looking over 100 years, tells you that's the US market, the Australian market, which is a very good places to be overweight.
Before you talked about the benefits of active management, in your view, where can active managers add the most value?
Yeah, what you find, it's generally where markets are most efficient. And so if you look at the scale of the companies and you go to small and mid-cap size companies, firstly you find, again looking at long periods of time, small and mid has outperformed large. And it's also a space where active managers typically generate more alpha than in large. And there's reasons for that. One of which is just smaller companies have a lower base, they can grow more. It's a bigger universe as well. So if large caps in Oz would be the first 50 stocks, small caps is 100 to 300 plus. There's more to choose from. There's some downsides, which is these stocks are less liquid and the quality can be more variable. And that's where the active manager can excel, because they'll know the management teams well. They could have been covering them for 10 years or more and can make good judgments to identify the quality. And you see very strong levels of alpha being generated in that space. I think there's other areas as well, but they're generally personified by having an inefficiency, which could be biotech, which needs significant expertise on the part of the manager. We see managers in the US with extraordinary qualifications, and they generate very strong returns. There's volatility, and that deters some people from the sector, but the potential rewards, if you invest in that space effectively, are highly attractive.
How about in the fixed income market?
Fixed income is less so our domain. We as a family office invest for the long term, and we find it's less tax favourable, and the returns, when you've got a long-term outlook, are not meeting the type of objectives we would set for return dimensions. There's nothing wrong with that, it just so happens to be our family office settings for how we're disposed.
Okay, I'm going to turn to you now, Louise. You obviously work with just a select handful of investment managers. What criteria do you look out for when you're deciding to work with a fund?
There's a number of things, but firstly, it has to be a boutique investment manager. Alternatives is the other thing I specialise in, as opposed to equities. I'm ideally looking for a manager who's been in a big shop somewhere for quite a period of time and been very successful. So it could be a number 2 or a number 3 person, but not the main founder of the business. They then decide to leave with a partner or 2 or 3 and set up their own firm. And I will typically help them raise for a first or a second fund. And the thing I'm looking for is that they put a large sum of money themselves in, so they've got skin in the game themselves, which is really important. And they've probably brought some family, friends, people they know well into the fund as well. And my role is then to help them scale it up. It could be a manager who is based here in Australia, but it also could be a manager who's offshore who wants to raise in Australia. Up until now, I've focused on Australian managers. I'd call them sort of emerging managers who are in that sort of 0 to 10, 12 years since establishment. And because I started the business during COVID, it was hard to get to know some of the managers offshore. So, where I can, I love to support and help managers that are based here in Australia, because I think there's an enormous amount of talent. But having said that, I'm very open to something offshore. In fact, I'm looking at the moment at India and Japan to see what opportunities there might be in those 2 countries, particularly India I'm quite interested in. Obviously a proven track record, it's super, super important, and a great reputation, but also the no dickheads is quite important too. I don't want anything that's too slick. I mean, you do see that sometimes, and that is often a turn off. The other thing is, often a lot of these managers, as Pete knows, they're quite on the spectrum. So sometimes you are looking for a manager who, they typically are on the spectrum, but also one that can present and is able to get in front of someone like Pete, because Pete does grill these managers, and in a good way, but they need to be able to handle that pressure as well.
You talked about having a no dickheads policy just now. Are there any other red flags that you look out for when deciding whether or not to work with a fund?
You can see some managers who have reinvented themselves. I've come across some where they've reinvented themselves in the impact space, and maybe when they were a fund manager years ago, maybe there was something that wasn't so ideal there. So I have an advisory committee that helps me really look under the bonnet and assess whether that manager is the right fit for the business. I only work with 3 managers at any one time, so I have to be super, super careful. So I'm very disciplined, very cautious, and particularly in the market as it is at the moment, because it is not an easy environment to raise in. So, you know, I live or die by the choice of that manager. The other last thing is that whoever I raise for, my husband and I invest in. So I think that's really important. So I'm not going to raise for a manager that we're not going to put our own money in. You really have to understand it properly, what the manager's doing. Like, because sometimes I see, sometimes I'd put some managers in the, dare I say, crap basket, and then there might be another basket which is a bit hard to understand. You know, I tend to not to do anything in the digital asset space because I find it a bit challenging personally. And then there's a lot of stuff in the solid basket, but I'm really looking for the outstanding and the differentiated. You know, it's got to be differentiated, and that's hard to find. It's often a bit of a needle in the haystack, and I'll talk about an example later of where I think that has really worked.
Peter, how do you find those outstanding funds, as Louise just said? I understand you have a tried and tested process for identifying these funds. Could you take us through that?
Yeah, we have a range of principles we think through. A really critical one is concentration. So we typically prefer funds that are more concentrated. So in our view, once you get into about 15 positions, potentially 15 stocks, the benefits of diversification start to be more limited. And maybe it's up to 20, but certainly that benefit fades away. And your concentrated investor also means you can analyse one particular stock in a much deeper way. You don't have to cover as many positions, of course. Yeah. And that can just be much more impactful if that particular position performs. You can have more significant portfolio weight. So we favour that type of approach as a differentiator. I would say to the point that was being made by Louise around alignment, that's fundamental too, right? So it's just natural for a fund manager to be asked the question, how much do you invest, right, in the fund yourself? And the perfect answer is that all of my capital, bar my principal residence, is in the strategy. You know, that's ideal. It's not critical that that's the case, but it's indicative of what you would like to see. Alignment means more than that. It also means how's the equity owned in that particular firm. And you'd want to see equity owned from the senior principals in the firm, but equally ideally they share some with more junior members. And you see motivation at the junior level as well, and also means that succession's been thought about. Some of the other factors you'd look about is funds under management. So there will often be levels, particularly when you look at small caps, which a fund will face some constraints in terms of maintaining performance when their capital base gets beyond a certain level. And every fund manager will have a different view on where they should cap their fund, right? So performance is not compromised. And ideally it's one that's more conservative, thinking selfishly from the investor perspective. You want to understand the portfolio as well. So ideally you're talking strategy, as Louise was explaining, but equally looking at the individual stocks in the portfolio. And you want them to correlate. What's my strategy? What are my positions? Is it entirely coherent, consistent? And you'll find at times there's aberrations. And we would have looked at a US fund recently. That's what we thought we were investing into, but there was an Israeli-based stock there. So that was a pass for us, and quite rightly so given recent events. They're some of the primary attributes. There's a much longer list as well, but they really start to set some funds apart on whether you might prefer them or not.
Is past performance super important to you?
We're aligned with Louise. Track record's quite critical. And it's like if you've ever done the wine test and been blindfolded and did you get your wine poured correctly? You can do it with beer, and I failed that one too. And what's the saddest thing at all, and you can do this, people, is fascinating, and you put the attributes, the investment attributes down of a fund on the page, and you'll say, does that generate alpha or not? Right? You say yes, without question, and then you see the results and it simply doesn't. So I think it's very hard to invest in this space without a sense of track record and having a degree of proof that the strategy works. Now that doesn't mean you can't invest in early stage funds, a la what Louise was saying, because track record exists in different guises, and it can certainly exist from operating under a previous firm.
Okay. Louise, there's obviously hundreds of funds available to Australian investors. In your view, what can an investment manager do to stand out from the rest of the pack, particularly when presenting to high net worth family offices like Peter works for?
Well, I think a lot of them are not great communicators, so they need to improve that. I think also fund managers and investment managers are good at communicating when they're raising money, but they're not so great, I find, after that point. So
also when they're performing very strongly. Fantastic
that's
communicators.
Exactly right. So I think, it's not a strength of most investment managers as well, but I think it's something, as you know, I was the CEO of the Future Gen companies, and having worked with Jeff Wilson, he's probably one of the best in the business at communicating, and I suppose I feel strongly about that after having worked, in that environment. But because a lot of managers spend their resources, building their investment team, but not necessarily the other side of the business. What else could they do better? I think more differentiation. Where I can, I really encourage a manager to think carefully about the strategy of what they're doing, and I will talk about another fund I've raised for where I think they did carefully think through that strategy to really make sure that they came up with something that was differentiated. And I know that can be easier said than done, but you do find in some cases there's just so many of the same type of fund around. You just think to yourself, how are these guys going to be around?
Peter, before you talked about liking fund managers that employ a high conviction approach, do you employ that with your own investment strategy in terms of selecting funds? How many funds would you typically hold at one time?
Look, I think that's a really telling question, because you just find there's vast differences. And if I think of our family office and others, you'd find a significant breadth of approaches they would take. More concentrated levels for a family office is circa 20 positions, being all you would have in a portfolio. You can see as many as 200 positions
oh my God.
In the portfolio as a family office, so vast numbers at the other end, right? We sit at the circa 30 positions. And just to give you some insight, let's say we're doing international equities in the listed market. We would say to ourselves, we want mix across large cap, mid cap, small cap with specialists at work, and that might take you up to 5 or 6 funds. And then there's other areas where you need technical expertise, and that could be biotech. There's a vast number of dedicated tech firms in the US. It could be long short funds, net long. There's activist funds as well. So there's a variety of specialists you'd look to choose from. Could you get you to circa 7 funds when you looked at that particular part of your portfolio?
Okay, and what do you do when a fund isn't performing as expected?
That's a tough question. What's interesting is there's a couple of instances where you might automatically be looking to exit a fund, and that could be a change in the portfolio manager. It could be where they're investing outside of the strategy, or you simply find something better. Now you're asking about the hardest aspect of all, the kind of grey zone where the fund manager is not delivering as you would like. What you essentially do, you've got your own investment process and you have to do that once again. And the judgments you came to first time, you've got to reassess them and see if you come to a similar outcome. You obviously need to meet with the manager and probe with them, because they will know about it. So we spoke with a manager today who's had a period of adverse performance after being a stellar performer for years. And when I turn up, they've got their prezzo ready, and many others have spoken to them to say, what's afoot. So it causes them to be introspective. Now, what you want to see most of all is the strategy's consistent, because when there's pressure, and it can happen with large investors putting some duress on the manager, they change strategy at the worst possible time. So we want to see consistency of strategy come what may, and the fortitude to work through difficult times. Because the worst thing that happens is you're buying high and selling low. But you're absolutely in the grey zone, and these roles are quite incountable in terms of being able to deliver results against return objectives. These are the hardest calls you'll make, I think, and it sets people apart. Typically, you want to do the most work you possibly can on entry, and it makes those judgments much easier as time goes on.
In equities, we say that you should let your winners run and that you should cut your losers early. Is the same true for funds?
I would say not. I think if you're cutting your fund early, that suggests something was wrong with the assessment process. So you would rather go back to your process and say, how did that transpire? Because that shouldn't be a result of it. And there's too many imponderables to markets. It's not like a trading dynamic. You invest with a longer term mentality, 3 to 5 years as a minimum, because there'll be cyclicality in the markets, and you can only override that through duration.
Okay, last question for today, Louise. I'm hoping you could share a fund with us that is commonly held by Australia's ultra wealthy and why you think that is.
Well, I will have to give one that I've raised for, and it's Fifth Estate Asset Management. So I did a raise for them last May, June. It was a second fund. It's actually a joint venture between Blue Lake Partners, which is a family office based here in Sydney, and Centennial Asset Management, the Australian small cap manager. And the portfolio manager is Dane Roberts, who is ex-Regal, small cap manager. Now, it was a second fund. They raised 50 million for a first fund probably 4 years ago, fully deployed that after 2 years. And this second fund, we raised 70 million last year in 2 months. And 70% of what they invest in, it's a pre-IPO fund, and 70% of what they invest in are companies that are 1 to 2 years out from a trade sale, or in normal times an IPO, but of course none of that happening at the moment. And 30% is really listed microcaps. So it's a hybrid of unlisted and listed. And the great thing about it is it's a 5-year closed-end fund. And a lot of these funds can be 10-year closed-end funds, so it's shorter, which people liked. But also Dane is able to generate some very decent returns in the early years from the listed microcaps. Because normally with unlisted you're hanging around for 3-4 years until you actually start to see some exits, whereas here he can generate some decent returns, and he's done that with both the first fund and the second fund already. But the other thing I loved about this one was that a lot of people were a bit nervous about us going out to raise this last year, but we did it in a very short, sharp raise over 2 months. So people really had to put up or shut up, which was good in this environment, and I think we did very well. But it was a fund that was a bit different, and some of the most sophisticated investors that I know actually took up the offer and invested in this fund, so it was good.
I can offer a family office perspective.
For sure, yeah.
If you like. So Fifth Estate's a fund we know well and rate highly. The interesting aspects for us, we talked about inefficiency earlier, and if you look at pre-IPO markets in the US, they're very deep. In Australia, they're relatively shallow in the sense there would only be circa 10 firms that have dedicated strategies in that area. So that as a starting point makes it of interest to us. I aligned with Louise's commentary entirely, and the other thing that we find interesting is cyclicality. So these funds invested substantial amounts in 2021 in the main. When you look across the broader markets, that's when valuations were at their zenith, right? But it was simply much easier to raise capital. Now valuations are more subdued. Such funds are investing in companies with far better terms than you've seen in the past. And the irony is not many people are putting up their hand to write checks. So we think as a family office you need to be counter-cyclical, go against the grain, and be uncomfortable typically at the time you're investing. And we'd like to believe that produces the best results.
I'm going to end there. Thank you so much for your time today. It was awesome to have a chat with you both. I think those insights were very helpful for our audience.
Pleasure.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.